All right, I'm Michael Hartzman. Today is Tuesday, February 24th, 2026, and I'm on my partner, Dominic Tavella. How are you, Dom?
Doing well, Mike. Little traffic and weather issues, but still sitting in Florida, which I guess is a good thing.
Yes, please. No one in the Northeast will have any sympathy for your traffic and weather issues as you
Well, the weather issues
strategically missed.
prevented me from coming up there, Mike. So sometimes you have to be grateful for the course that life sends you down.
Yes, because you strategically missed about 20 inches of snow in your neck of the woods. We got about 16 inches. And I was telling our guest, Jeff, before the show, that my landscaper, who takes very good care of me in the winter as well, showed up at 1 a.m. with a snowblower to shovel my drive, to plow my driveway. I'm sure my neighbors were thrilled.
You know what, Mike? God bless these hardworking people. That's all I'm going to say on the subject.
Exactly. If anyone wants to go to sleep, it's okay. So look, let's just jump right into it, Dom. Last week, there's always seems to be a seesaw or whipsaw. But last week on Friday, the much anticipated Supreme Court ruling came out, and surprisingly, it was definitive that the Supreme Court felt that these tariffs were illegal and installed illegally. And when I saw that, I said, okay, well, there goes my Friday. The market's going to get killed. And then it didn't, but then it did yesterday, and then it bounced today. And you know what, Dom? Look, we both know that what the market hates more than anything else is uncertainty. So kind of here we go again. The tariffs are illegal, but then Trump puts them back on, and then okay, they're illegal. Well, we're going to pay these people back anyhow. So what difference does it make? So I don't know. To me, Dom, I just see a lot of uncertainty and a lot of choppiness for a little while here.
And I want to go, what else is new, Mike? So the first commentary on the tariff ruling by the Supreme Court, they clearly ruled that President Trump overstepped his authority. The funny part is they did not tell the Trump administration how, where, when they were supposed to pay the money back to the companies that paid the tariff. So the big ambiguity about how do we get the money back to these companies is not even decided yet. And it was amusing that Trump goes, yeah, we'll be in a court for the next 5, 10 years, determining where these companies and how these companies get their money back. But the market's reaction to the ruling was rather muted, right, Mike? We would expect it. It could have been pretty violent, negative, but I think the ruling was anticipated as both you and I go to our sources, and they pretty much said the Trump's going to lose this one at the Supreme Court. So I think the market got it right in they anticipated that Trump was going to lose on this ruling. And then the flip side of that, so the Trump figured out they couldn't get the money from the right pocket, so he's now going to take it out of the left pocket by imposing a different tariff, Section 122. Who cares? But the tariffs will continue, and the noise and volatility from tariffs will continue.
Yeah, but here's the thing. What expression, if you recall, did we keep hearing about this? The Supreme Court will figure out a way to thread the needle. Remember that? We heard that a lot. And maybe threading the needle is that ambiguity about paying them back or not paying them back. I would think they left that out on purpose.
That's a great point, Mike. You would think something as important as that, they would have made a ruling, right? Hey, you got to give this money back, period, right? Or you don't. Um, but they left it completely open-ended and maybe for a later decision. But it does take, this I think is the key point. It does take the pressure off of the federal government how to figure out how to come up with anywhere between 150 and 300 billion dollars, i.e., they don't have to go to the bond market and borrow the money today. It may give them some breathing room here in accumulating that money and how to give that money back. So again, I think a little relief from the market on Friday that it wasn't all doom and gloom.
Yeah, but okay. So I'm going to put you on the spot a little bit. What do you make of the 800 point drawdown yesterday, though? Was it just a day late?
Um, I'm gonna say no, Mike. As you and I both know, a significant amount of the correction we're seeing in the markets on a year-to-date basis is very, very focused on these AI technology companies and the AI software companies. We had a major event in one of the companies that provides financing for this AI software technology. I think that spooked the market, Mike. I think that a little bit unrelated to tariffs. I think it was the event of, I don't want to get into the specific names of the specific companies, but there was some issues with the money that's going to be needed to move forward with this AI technology and where's the money going to come from. And I think that spooked the markets.
Yeah, and I agree. We don't need to name names. We don't need to give our compliance directors any more odds
Yeah,
than
we
they
we
already
we
have.
have to de-stress our compliance officer, so we'll keep it as clean as possible.
Exactly. Now, another headline, Dominic, that kind of got buried in the tariff headline is the GDP number was not a little disappointing. It was disappointing. I mean, it wasn't a miss, it was positive. But, it only grew, the fourth quarter only grew at 1.4%, way below expectations.
Way below expectations. The GDP number for the fourth, usually the first quarter is one of the weakest GDP numbers, and the fourth quarter usually is one of the best GDP numbers. This one was particularly disappointing, but again, we were dealing with a government shutdown during that period, and the feeling is that that government shutdown and a shutdown of activity during that period affected the GDP number. So again, kind of taking it with a grain of salt. Remember, we got that big number the quarter before, Mike, at
Yeah.
5% growth in
Yeah.
GDP. Again, that number, people look at it and go, oh, there's some things underlying skewing that number on the upside. This time, there's some underlying numbers on the downside. The real number, and again, you always got to take this with a grain of salt, I think would have come in somewhere around 2.5%, with about 1% coming off the top because of the government shutdown. We're going to take it with a grain of salt, Mike. We won't get too high on the good numbers. We won't get too low on the bad numbers. I think it's all kind of explainable, but we'll see what happens with the next one.
So I'm going to use one of your favorite expressions. So with the inflation number being a little wonky and the GDP number being a little disappointing, I still think we're kind of betwixt and between when the new Fed chief comes in on, do we get two rate cuts on the downside? I mean, inflation is still not anywhere near target, but the economy's not as strong as we thought. So again, it's just kind of I feel like we're kind of in never land.
Yeah, it's kind of like it's not too hot, it's not too cold, kind of lukewarm, somewhere in the middle. Yeah, the inflation number has not, it's not terrible, but it's
No,
not coming down. And that's the big thing, right? It's not coming down. In fact, there's some whispers out there that it'll remain relatively high. Again, not we're not talking about 4 years ago high, right? But relatively speaking, higher than what the Fed wants. And to that point, we all know how what's the polite word here, Mike? Trump's been anti the current Fed chair about not lowering interest rates. Well, the new Fed chair coming in has already hinted that, hey, he may not be ready to cut interest rates just yet. So as I found it ironic that the whispering thoughts coming out of the new Fed chair is, hey, we need to be a little cautious here about cutting interest rates. So there we go again, Mike. I expect another tweet at 3 o'clock in the morning.
Dom, you are very polite. He's called it Jerome Powell a dummy on more than one occasion and wants to have him arrested. So you are extremely polite.
I think under this format, it's appropriate that we do so, Mike.
Well, look, let's let's
Don't
stop it
don't give me
right
an
there.
extra martini though, Mike. That might a few of my things might slip out.
Exactly. But yeah, you're right. There's a 3 a.m. mean tweet or mean truth social post in someone's future, I'm sure. Um, Look, tonight we have a returning guest, Jeff Oak, who we officially call a friend of the show. I think this is his fourth or fifth appearance. He very graciously comes on the show every quarter and shares with us the Vistage CEO Confidence Index. And tonight I'm going to call one of my favorites, Yogi Berra. This really is deja vu all over again. This report, because it talks about what we talked about a year ago, the uncertainty with tariffs, the enthusiasm heading into the year. So, we're looking forward to Jeff's thoughts and put him on the hot seat, and you and I get to ask the questions,
Yeah,
Dom.
one of my favorite guests, Mike, and as everybody knows or should know, we follow the leading economic indicators in modeling our portfolio. So we're very conscious of this kind of data, and the idea that we can get it live every quarter is just phenomenal. We can bring it to our viewers and our listeners. This is a phenomenal resource. One of my favorite guests, Jeff Oak.
So we will be right back with Jeff Oak, Vistage Chair, actually my Vistage Chair on Long Island with the CEO Confidence Index. All right, I'm Michael Hartzman, back with my partner Dominic Tavella and our special guest this evening, Jeff Oak, Vistage Chair. I think you're up to 5 groups now. I'm a member of one of them,
Yep.
Jeff.
Yes, that's
So
right.
welcome back, and how are you?
I'm delighted to be here, Michael. One of my favorite times of the quarter is the time to chat with you and Dominic.
Thank you. We appreciate that. And as Dom mentioned on the close of the first segment, what you guys do is very valuable. And more importantly, or as importantly, the way you break it down for us is even more valuable than the data you give us.
Mm.
So let's just start from 30,000 feet in the air. What was your takeaway and now let's be clear, it's the fourth quarter of 2025. The data
Yes.
was collected at the end of last year. So what's your takeaway of the small and mid-sized businesses that were surveyed?
So I'm going to preface my answer to that by reminding your audience that this is a survey of sentiment, CEO sentiment. We call it the CEO Confidence Index. And I think the sentiment that I see here is that CEOs are getting a clearer sense of what they can and cannot control. And we usually say that of ourselves when there's a lot of things outside our control, and learning how to balance that with the things that we can control. So that's my message. It's a little bit of an echo of Dominic, your earlier comment, and yours, Michael, that a year ago, it's sort of like deja vu all over again, that we were a lot of concern about tariffs a year ago that led to a huge drop, the largest drop in the 22-year history of the Vistage CEO Confidence Index. And it's been a little bit of a whipsaw. It went up around the time of the election, dropped precipitously in January, improved. And this survey does not account for the news in the last couple of weeks relating to a renewal of the tariffs, notwithstanding the Supreme Court's ruling. I won't get into the details of that, but that's my takeaway. CEOs are learning, getting a clearer sense of what they can and cannot control.
So, Jeff, we always like to say, business owners, if you just tell me the rules of the game, I'll figure it out.
Yes.
And so is that part of what's going on? And then slash, given that we still have a lot of ambiguity, what have they figured out?
I think the figuring out part reflects an extraordinary capability among small businesses to adapt. They're small, so they can pivot quickly. I think a big part of it is adaptation and the capacity for adaptation that so many small business owners have, and that adaptability has enabled them to thrive. And the second component, in addition to adaptability, is there are some tangible improvements in some of the metrics on which this survey is based, which we can talk about when we get to it.
So, Jeff, between our advisors and our staff, Dominic and I employ between 40 and 50 people. So, we're proud of what we built, and we're a mighty, but by any metric, we're a small firm.
Yep.
So I read the second paragraph of the report, and it really makes me smile, and it's surprising how mighty these small firms are. It says U.S. small and mid-sized businesses represent the most vital sector of the nation's economy, creating 75% of all new jobs and generating 50% of all national revenue.
Yeah.
And, I think a lot of people, when they think of, businesses, they think of the behemoths of the world, right?
Yeah.
But the sector that Dominic and I have lived in our entire lives, this really is the engine behind a lot of the growth every single day in this country.
Absolutely. I mean, we read those numbers at every time we gather, and even when I read them now, it causes me to pause. 75%, as you said, of all new jobs and 50% of all national revenue. That is stunning.
Yeah.
Stunning.
And it's to that point that why these surveys are really so important, right, Jeff?
Yes.
Stating the obvious.
Yes.
That if the mood of this particular group of companies is negative, that's a pretty big headline in terms of, listen, there's no crystal ball. It doesn't necessarily predict the future, but it gives you a pretty good guideline of what to expect coming down the road.
Yes. And we've sort of, the economists that help us interpret this data noticed sort of almost by accident a year or two ago that the results of this CEO Confidence Index of small and mid-sized companies is a leading indicator by about 9 months of the productivity index, which is a very key macroeconomic measure. And it's kind of cool that this data anticipates leading indicators are very rare, very cherished. And the U.S. Industrial Production Index, which in turn drives many other indices, our survey is a leading indicator by about 9 months.
It's amazing. So Dom used a great word. It really boils down to the essence of this is mood. So before we talk about the mood, I'm just going to ask you if you can, because I know you didn't write it, but I'm going to ask you to interpret the quote or the line that you highlighted that I noticed immediately, Jeff. Sometimes we remember the pain of the hangover more than the fun of the party. What do you think?
Kind of makes you pause, doesn't it?
It does. What do you think the authors of this report was trying to get to by that?
Here's my takeaway. After the election, the CEO confidence index surged based on hopes for pro-business policies. That was the party. That optimism faded in January as a result of a variety of things post-pandemic. It really dropped to a post-pandemic low. The tariffs were a very significant, probably the biggest factor, but also political instability, including globally, and rising costs. Lots of attention on that. And then that was a little over a year ago. And the slight improvement in all 6 of the indicators, the primary indicators on which this survey is based, has seen an improvement. It's improved by 7 points, which is a meaningful jump in this survey. It's not dramatic, but it's a very meaningful jump. And it puts it now above the 3-year average for the first time since almost a year ago. And so I think that's the after the hangover is over, there's some memory of good tidings, some measure of optimism is how I interpret that comment.
So, Jeff, I want to bring up a point. In earlier calls that we've done with you, your survey was pretty accurate about small businesses not really being in the mood to fire anybody, and not necessarily being in the mood to hire anybody. Of course, now it's a headline. Your survey, I think, picked that out way before it became a headline that we're in a no hire, no fire economy. Are we starting to see something a little bit different, hopefully positive?
I think it's somewhat positive. And this is I'm going to describe another factor that's uniquely characteristic to small businesses, or at least it's a superpower among small business owners. The data shows that CEOs are adding headcount where it makes sense. They're evaluating hiring decisions and whether to invest in them through a lens of what's the return going to be and how's it going to help us with execution. So small business CEOs, it's like the old the license plate from Missouri. It's Missouri is the show me state. Small business CEOs are sort of show me. And if there's a little bit of good news, they're going to move forward a little bit based on what makes sense. With respect to one dimension of hiring decisions relates to employees outside the U.S. This survey is showing that CEOs are supplementing domestic hiring from employees outside the U.S. when they need to manage costs and when they need to fill certain skill gaps. So they're being very both tactical and I'm sorry, both strategic, these CEOs, but they're making tactical moves based on what makes sense. It's not, you're right, it's not a full bore hiring um, spree. Neither is it full bore firing. It's adding where it makes sense in incremental ways.
So, Jeff, since you mentioned hiring from abroad, does Vistage, again, I'm putting you on the spot. If you don't know, you don't know. But has Vistage in the last 9 to 6 months asked small business owners how the immigration policy in this country, which I think has cast a way wider net than anyone anticipated a year ago, do you have any sense how that has affected um, either businesses keeping staff or growing their staff in certain businesses that need that type of labor force?
Vistage has not surveyed CEOs on that question. It's a good one, Mike, but um, Vistage has not surveyed them. Anecdotally, um, as you know from the group that you're in, and as I really know on a broader scale, uh, tremendous variety of companies who are Vistage members, and certain industries are more dependent on non-U.S. Citizens, and um, our survey did ask um, our members, which is what the survey is based on, the percentage of companies that have employees outside the U.S. or contractors outside the U.S. and those who have employees or contractors inside the U.S. And it's the offshore employment in the employment pool, and about 2/3 of Vistage companies report that they do not have employees or contractors outside the U.S., and about 1/3 do. And I know that certainly by industry, based on my experience with the members of my various groups, construction, landscaping, certain parts of hospitality are much more dependent than many other industries, and so I think it's impacting different industries differently.
So let me just switch to Dom on that point. Dom, you spend way more time in Florida than I do. Have you noticed, to Jeff's point, when it comes to hospitality, have you noticed a difference in any of the restaurants down in Florida?
Um, uh, and again, this is very subjective to my
Of
my own
course.
environment and what I've been to. But the answer is not really in terms of the staffing, but we certainly have firsthand reports of immigrants being taken away, and immigrants refusing to go out in public, and immigrants leaving state. Florida can be particularly harsh on immigrants versus other states anyway. And literally immigrants, firsthand knowledge of immigrants choosing to leave the state to safer, what they perceive to be safer ground. So there is a real impact to the immigrant community of this policy being taken on by we're not going to get into the pros and cons of it, nor should we at this point. But there really is a real impact
Yeah.
on the immigrant community in this country. There's no doubt about it.
No, absolutely. And we're not going to get into, any of that, but it does affect hiring and staffing in certain sectors. I think Jeff is
And Mike, I
exactly
literally know
correct.
employers who've lost employees,
Yeah.
both by choice and non-choice. You can read into that what you wish, but it does affect the employment situation and
Yeah.
employers.
Yeah, no doubt. So I threw you a curveball by asking you a question, actually, Dom, but we follow the format. It's actually your turn to take a swipe at Jeff.
Jeff, I was very pleasantly surprised to read that there was an uptick in the confidence level, but I was also surprised that it happened in the fourth quarter when the government was shut down. Is it just a coincidence, or people just happier when the government gets shut down?
I think I was joking with Michael earlier today that perhaps the most important piece of data with this survey is that it's based on responses between December 2nd and 16th. So at that point in time, tariffs was not, it was certainly in the news, but it was not the bold headline that it's been since the Supreme Court ruling last Friday, and then the president's announcement about utilizing other much more obscure parts of the law to continue to justify them. But in December, it looked like many of the tariffs might be going away or substantially decreasing, and they're back in the news this week, the last 2 weeks, really. So
yeah, they're and they're back in the news in a way that just creates uncertainty. Right, the tariff level may not have gone; it's not going to go up very much, but as you said, it just creates uncertainty because it's back in the news. It's a headline again.
yeah, yeah.
All right, listen, let's take a break right there, and when we come back, Jeff, I want to also ask you about you guys separate the survey between the tri-state area and the national area, and some of the answers that we have between New York, New Jersey, and Connecticut is a little different than what the rest of the country is feeling. So I want to get into that a little bit.
Okay.
So we'll be right back with Jeff Oak, Vista's chair on Long Island, discussing the fourth quarter of 2025 CEO Confidence Index. All right, I'm Michael Hartzman, back with my partner Dominic Tavella and our guest this evening, Jeff Oak from Vistage, discussing the CEO Confidence Index. And Jeff, I just want to point you to the page. I'm going to put it up for a moment where you guys talk about how the sentiment is in the tri-state area, which is New York, New Jersey, and Connecticut, versus the rest of the country. And when you ask the question, compared to a year ago, have overall economic conditions in the United States improved? We here in the Northeast said only 14% said it improved compared to 22% around the country. And most of us said it remained kind of the same, and 39% thought it worsened, which is kind of what it was compared to the rest of the country. And then the next question was, do you expect overall economic conditions in the US to be better? And again, we were below what the national opinion was. 28% of us said yes versus 32. But then when we came to the question, well, how do you feel about your own business? It was kind of spot on. 68% of respondents, in spite of how they feel about the economy, feel that their own business will increase over the next 12 months compared to the rest of the country. It was 68 to 69. So there's a little bit of a disconnect when it comes to us here in New York, New Jersey, and Connecticut are we just naturally more pessimistic, or and we just, when we're running our own businesses, we kind of bowl through all the nonsense? How do you shake out this data that we're somewhat less optimistic than the rest of the country overall, but when it comes to our own business, we're like, the hell with that, we're going to grow this thing?
Yeah. My answer to your question is yes. You've heard me say on other episodes, my approach to data is there's the what, the so what, and the now what. The what is the data, the so what is what does it mean, and then the now what is what do we do with it. I can tell you what the data is. I have no idea what it means. Your theory is a pretty good one, it seems to me, that there's sort of a cultural pessimism or cynicism or edginess to the New York metro area, and also a go for broke, aggressive, I'm going to win, I'm going to build this thing, I'm going to win. And both of those things can be true simultaneously, would be my guess as to what that means. What I will say is that in general, when I track this over the last number of years, in general, the tri-state area tends to be more bullish on the economy in general. In part, I think, because it's the financial center of the world, and that provides a lot of stability, a lot of power, a lot of economic power. And so why some of these numbers are significantly, or they're lower enough that they catch your attention from the national numbers, is a little different from what I've seen in the past.
Okay.
So if you don't mind, both of you, I'm going to piggyback on your question slash answer. A year ago, we literally were in New York with the biggest financial institutions in the world, with them saying somewhere between a 40 and 60% probability of a recession. Your survey correctly said no. Any whiff of any of that in your survey today?
In terms of saying no to
Economic activity going into a recession.
Actually, what this is measuring is the sentiment in a certain quarter. The economists who help us to interpret this data has actually postulated they have a very high accuracy rate in their forecasting. They do anticipate a significant downturn, roughly in the 2030 range. It's difficult to pin it down too tightly. That's been a fairly consistent forecast that they've offered. They tweak it a little bit here and there, but they really have not backed off from that in the last couple of years, actually.
So just to be clear, 2030 is in the year 2030.
2030, yes.
Got it.
4 years hence.
So, I mean, and is it true? I know last year at this time, small businesses were very pessimistic because of the tariffs. But what you're saying, Jeff, is historically, guys like Dom and I, small and mid-sized business owners, we have to be optimistic, right? I mean, we have to be. Otherwise, we're doomed to failure, aren't we?
Yes. I mean, I think one of the core roles of a leader, including a leader of small businesses like you and Dom, is projecting two things simultaneously: optimism, and whatever the opposite of Pollyannish. So the ability to look at reality and accept it for what it is, and not shirking from it, not averting your eyes, not turning away, not wavering in terms of the actual realities that we confront, while at the same time projecting hope and optimism. It's often called the Stockdale paradox, by the famous military leader who was a prisoner of war for almost a decade. And that's the way he sustained the morale of his troops, his fellow soldiers in that prison, was by both being realistic and projecting hope. And I think that's a key role. It's a wonderful model from a key military leader. That's a great model of mindset for small business owners too.
And your survey really talks to, I'm going to read your headline, future economic expectations of CEO shifts towards stability as fear of economic decline fades. So generally speaking, we're getting a little bit more optimistic about the future.
Yes, slightly. Yes. It's not going to knock your socks off. But
No,
again,
no, but the fear of a recession in my book, and this is to Mike's point, if you're worrying and driving your economic decisions based on you think a recession's coming up, that's very different than somebody that's looking at the picture very optimistically, and whether it's hiring, capital investments, that's a two different kind of mindsets,
yes,
right? One is protectionist, I got to save what I can, versus, hey, I'm willing to commit resources, capital, people towards growth. That's a whole different mindset in terms of projecting what the future is going to look like.
exactly. And I think what we're seeing, getting back to the sentiment of the CEOs, two things that I call our attention to that I think shed light on the way CEOs think, what they're feeling, and how they navigate. CEOs increasingly are planning around scenarios that they think they can manage. That gets back to the adaptation, and that there is some modest tangible improvement, but planning around scenarios that they can actually manage. In the face of the challenge of margin pressure, the survey also shows, it documents kind of what many of us know and see, intuitively, is that revenue expectations are driving some of the improvement, much of the improvement in confidence, but confidence in revenue growth outpaces expectations for expansion. What that's showing is that there is substantial pressure on margins. This survey is beginning to show that CEOs aren't waiting for that pressure to ease. They're building plans around it. They're banking on tighter operations, banking on smart price adjustments to turn those revenue gains into sustainable growth. The path to profitability runs through discipline. And what we're seeing is a doubling down among these CEOs on the disciplines that we associate with the fundamentals, managing costs, efficiency improvements, building talent, developing leaders, and building plans that are adaptable, that are flexible. We're seeing that they're dealing with the hands they're dealt and trying to make the best of it. And they got a few cards, but they don't have they don't have a flush or four aces.
Jeff, you use a really important word. It's discipline. Dominic and I are inundated constantly about the next new shiny object, the next new product that we should be offering our clients, the next new investment that's been thought up out of thin air. And really, the genesis of our friendship and a partnership is the very first time he and I spoke. We talked about, I'm not going to name the product, but Dom and I both agreed quickly that it was made out of thin air. It was nonsense. And before the show tonight, I emailed Dom a story about the hot product now, which everyone was talking about, the new shiny object that Dom and I never offered our clients. And now I think the first shoe is going to drop, that this product is not all that was made out to be. And you use the word discipline. That's what it reminded me of, that as a small business owner, we can't afford to step out of our lane and B, get distracted by every new shiny object that comes along our way.
Yeah. I think those are wonderful comments, Michael, and tremendously wise. When I talked about earlier, and I want to circle back to this, which builds on your comment, circle back to the what, the so what, and the now what. And what always interests me the most about this survey is what do we do with the insights here? And so, kind of what's the punchline, if I can put it that way? And it gets back to fundamentals. The decisions and investments that this data is underscoring need to be made. I'm going to highlight three of them, the top three. First one, people remain at the center. The fundamentals of hiring and retention, of developing leaders and doing succession planning. There's no shortcuts for those things. You got to get them right. And when you get it wrong, you got to fix it and make it right. So keeping people at the center. The second key investment area that this data directs us to is growth and engaging with whatever your market is. In the face of pricing pressure, cost management, and shifting customer demand, CEOs have to respond with tighter execution, which is what you're alluding to. Tighter execution, a laser-focused market, laser focus on the market that you're serving, and targeted investments, and pricing strategies need to be flexible. So that's the second set of fundamentals. And then technology, and I'm going to include AI here. We're seeing in our last, I think it was our last session, you were talking, how much adaptation or adoption are you seeing among AI? I think we're beginning to see a movement toward integrating AI more centrally into core systems, core workflows, and core operating models. And AI cuts across both people and the growth strategies, the first two items that I mentioned. And investments have to be aligned with long-term capability and long-term needs. So for all the fancy data and whatnot, I think we come back once again to the most important things, which are fundamental disciplines relating to people, relating to growth, relating to markets, relating to technology.
So, Jeff, I read the report and generally speaking, pretty pleased. And my brain immediately went, so it's all good, right? Until I got to, I think, one of your last pages where it said CEOs planning to hike prices in the next half of CEOs surveyed expected to hike prices 4 to 6% in the next 6 months. Now, whether they will or won't, we won't know yet. But that's a pretty hefty number. I
Yes.
think you would agree.
I do agree. And what we're seeing is that these pricing increases are more to offset certain costs, labor, insurance, supplier costs. They're not pricing strategies that are aimed at increasing margins. They're aimed at maintaining margins where they are. And so, again, it gets back to the pragmatism and adaptability and discipline that many small business owners have to utilize all the time. And yes, that is a big increase that half of our CEOs are saying that they're prepared to make in the next 3 months. And it's important to peel back a little bit about what that's in response to. It's in response to those cost items that have gone up.
So Dom, to the point you've been making right along for the last year, and Jeff, you've made along the way, are we going to end where we started with tariffs? Because if they're going to raise their prices 6 to 8%, Dom, the data we've seen, and Jeff, the data we've seen is small businesses are going to have to absorb some of those costs and they're going to pass them along. So wouldn't these numbers basically tell you guys that that's kind of what's happening right now?
For me, it's hard to draw a straight line from the pricing increase directly to a particular tariff. It is certainly the case that the cost of labor, the cost of insurance, the cost of supplies have gone up. And probably a lot of factors, and probably, and most certainly for many industries, tariffs among them. But these pricing increases are more defensive than offensive. They're more to preserve. Michael, at our meeting last week, we were talking about defensive strategic moves and offensive strategic moves. The data is showing that this is a defensive move in response to higher costs.
Dom, you have an opinion on that?
Yeah, we're always, and I want to stress this is a survey, and this is what small businesses think they're going to be able to do, right? So to the extent that it's predictive, it's just what people are thinking, business owners are thinking. Having said that, the expectations that overall inflation is going to decline dramatically for somebody like me, like, I don't think so, right? It may not go up dramatically, but it sure doesn't look like to me it's going to come down dramatically.
Yeah, and look, I mean, Dom, and we are perfectly okay with it. But we are in a very unique business because financial advisors in general, we never raise our fees. If anything, our fees have been going down steadily for 20 years, if you think about it. So when it comes to margins, we're typically left with the decision, oh, we just have to grow our businesses to keep up with the higher cost of doing business. But other businesses, whether it's a restaurant or a hardware store, they do have the luxury to have kind of these stealth price increases along the way.
And like many small businesses, Mike, we implement technology,
Yeah.
we implement efficiencies, we try to cut where we can, right? But you are correct. We're not in a business in our world. We're not in a business where we raise prices. That doesn't happen. But a small business owner that think of a contractor that's building a house. Some costs are the real, and they either pass them on or they're out of business.
Yeah.
Oh, look, I worked from home today and I did a DoorDash order, and a turkey burger was $25 for me to get a turkey burger at my door, which is, I passed on the
Well, that's
turkey
your first
burger.
mistake, Mike. You shouldn't be looking at turkey burgers, but that's a conversation for us to have off the air and not on this
Well,
podcast.
Dom, in my
Um,
defense, it was not a meatless burger, which I know
oh,
horrifies
thank
you.
God. But all right, that's again another. So Jeff, this inflation in question. I mean, we're trying to make light of it, but the inflation data that we get from the government is really important in determining what we do and how we allocate our resources and portfolios. And this, to me, again, I got to always take everything with a grain of salt, but it's a pretty. I think we're being honest with ourselves, the survey, and the rest of our listeners and viewers that, hey, if you think inflation is going to go to zero in the next 6 months, you might want to take a deep breath and hold on because it doesn't look like it's going to.
Yeah, that's what that's what this data is suggesting. That's the perception of the CEOs.
Pretty important takeaway, I think, from an
Yeah.
pretty much all good survey that you gave us.
Yeah, yeah, yeah.
So Jeff, just in summary, with 2 minutes to go, overall, what is your impression as we're kind of 6-7 weeks into 2026, based on what the members were feeling at the end of 2025 and what we know now? And again, we'll put you on the hot seat in a month, in 3 months, and ask you again. But are you mostly optimistic about 2026 based on what we're hearing and reading?
I think based on my reading of this data that there's modest improvements which lead to modest optimism, and there remain substantial pressure on margins. I happen to agree with your sentiment, Dominic, that I'm not seeing how inflation is going to go to zero. I mean, it may stabilize, but it's difficult to see it dropping, significantly. And there's some stabilizing factors. Workforce expansion is stabilizing. Revenue and profitability is okay. And so I think there's room for cause for cautious optimism based on some of the numbers we see in this report.
So Jeff, we got to stop there. And as always, thank you for your time and sharing the important Vistage report with our clients and you making the time, after hours. We always appreciate our visit. We always appreciate the conversation.
Thank you. I love joining you, and it's a real honor. And I always learn so much from your wonderful questions that keep me on the
thank you, Jeff.
keep me
Again,
hopping.
we value the research and your input and your insights, and again, appreciative that you're willing to even come back. So thank you very much for that.
It's my pleasure, Dom. Thank you.
So Dominic and I will be back next week with a new edition of the Lebenthal Report. Have a good night, everybody.
Good night, all.